back to another episode of Beating Alpha. This is episode 105, and we have a very special guest. I will introduce to you him in a few seconds, and very happy to have him on. His name is Rob Beardsley, and he oversees acquisitions and capital markets for Lone Star Capital that you can find at lonestarcapitalgroup.com, and has acquired over $100 million of multifamily real estate. He has evaluated thousands of opportunities using proprietary underwriting models and published the #1 book on multifamily underwriting, which of course we're gonna go in deep and explore what is that like to underwrite multifamily deals. The definitive guide to underwriting multifamily acquisitions. Probably you can find that on Amazon, or we're gonna get that link for you guys. He has written over 50 articles about underwriting, deal structures, and capital markets, and hosts the Capital Spotlight podcast, available on iTunes, of course, which is focused on interviewing institutional investors. Again, more information about Rob and what he does at robbeardsley.me. And of course, all these links to the social media, Instagrams, Facebooks, YouTubes, everything is going to be down below for you to follow. Rob, I appreciate you joining me today on the show.
Thanks for having me.
That's no problem. Happy to connect. So look, first question first. How old are you right now?
23.
23. Here you go. 23, $100 million of multifamily in real estate, and a book about, underwriting. I mean, where's that coming from at 23 years old, right? So the question would be can you talk about your personal background, where you're coming from, and how did you get involved with the real estate investing?
Sure. So my background, I grew up in Silicon Valley in Northern California, and despite being surrounded by technology startups and the giant technology companies of Silicon Valley, I grew up in a real estate family. My parents ran a real estate brokerage firm out of their home, essentially. So they both worked from home. So I spent a lot of time with them, overheard their phone conversations, and just really was immersed in their business from a young age. So I kind of didn't realize how much real estate I really knew and understood, because it just felt common to me, or it felt like, of course I know these things. I hear it all day. And so, that was how I grew up. But then when it was time to go to school and start focusing on a career, my parents didn't want me to pursue real estate. They thought that tech was more sexy. And they, being in Silicon Valley, they thought, oh, well, look at all the people that are selling their startups for $100 million, $1 billion. That's what you should do. And so I went to school for information systems and was, learning computer science. But, pretty quickly I came back around to real estate and was fully obsessed and studying on my own time, and was, starting to think about investing and actually making investments and building my own business. And it essentially consumed me to the point where I decided it was best to leave school and start my company, Lone Star Capital.
Wow. Okay. So a few things to cover here, because I have so many questions coming up to my head. Again, first of all, your parents are involved in real estate. They own a brokerage in California, right? So how did they give you that kind of, there was like, oh, don't pursue the real estate business? Why is that?
To be honest, I think it was because the way that they were approaching the real estate business was in a way that they weren't particularly satisfied with, and didn't, want the same for me, because, they were essentially, running a very, any business is hands-on, but a very transactional business, a lot of work, a lot of clients, and they're not really building a portfolio on the brokerage side. And, so they came from that background, and the lack of scale associated with residential versus commercial. And so I think that was the big difference. Once I was doing my research and exploring and saw that, commercial real estate could be a very exciting and lucrative path for me to pursue, that was actually scalable, not only scalable in terms of company size, portfolio size, income size, but also scalable in terms of my passion, right? It's something that I'm not necessarily going to grow out of, because there's always something new. There are always new challenges associated with growth and every step of the way. So it's a very rewarding business to be in.
Well, I agree with that. $100 million in real estate so far. So, I mean, it seems like you guys are doing pretty well for yourself, in these times. But the question that I have, I mean, you follow then the education, which you said, what do you have studied before?
Information systems.
Information systems. So, and of course you quit, that so he was like, I need to leave because it doesn't make any sense. Have you found that, I mean, the education, how much you acquired of that education, I don't personally know, but did it help you to, in your real estate business a little bit?
Sure, it definitely helped a little bit. One thing about computer science is it's essentially a skill in problem solving, right? Once you understand language, then you just are basically trying to solve problems through the language. And problem solving, I think, is one of the most valuable skills, and it applies across, all disciplines. And so I definitely took away that rigorous problem solving attitude, to everything I do. And yeah, so I definitely, you know, took that away from it.
And I'm sure maybe you kind of came up with something that helped you maybe craft the underwriting process. Maybe there's something to that too, but of course we're going to cover that. One thing that I wanted to ask you again, you learned from your parents things on like what not to do, which is obviously not have, hundreds of thousands of different transactions, which is like on a sales job and maybe it's too boring. So have one transaction where you can close a big unit apartment or something in that nature, right? But what is the thing that you took away from your parents as a business people? Like that was a great advice.
Well, my dad is a huge mentor to me, and I'm very fortunate for that. And so he's one of the most hardworking and determined people that I've ever been around. And it's his great skill, but it's also a fault of his because he's so persistent and he's so determined that he'll pretty much accomplish whatever he's trying to accomplish. But sometimes it's a Pyrrhic victory, right? It's to what end, because there
Mm.
might have been a simpler solution or something like that. So it's a balance that you need to have, because for sure to be successful in any way you have to have that determination and that persistence, but at the same time you can't just take that advice and go bang your head against a wall 1,000 times hoping to break through. You need to go and find the window or the door to get through that wall. And so that is something that I both at the same time both learned that was a very good trait, not giving up and things like that, but then also think working smarter, not harder, and finding those, you know, optimal solutions.
Got it. Got it. Okay. So your personal journey in real estate investing, I would like to talk about that also because I mean, 100, again, just mentioning 23 years old, $100 million acquired with a Lone Star Capital so far in multifamily deals specifically. So can you talk about the first deal that you came across? Can you give us like a little bit background and the story behind it?
Yeah. So when we first started out, we were just trying to get more familiar with the business and trying to gain experience. And so the way we did that, which I think is a very realistic and it's a good way to go, which is to partner. I mean, obviously, partner with people who have more experience and potentially take a more backseat role in your first deal or two. Not not necessary, but it's definitely a great way to learn. And you learn a lot more than you think. You think, oh well, how am I going to learn by just kind of taking a back seat and letting somebody lead the way? But you do. You learn a lot. And so even if you just go through the process of, for example, partnering with somebody and raising capital, you're going to learn a ton because you're going to be asked questions from your investors. You're going to learn about, the closing process and then the actual asset management practice. So that's what we did. And we raised a few dollars from some family and friends, investors who were, who saw our vision and believed in the investment thesis. And then from there, that allowed us to grow and pursue our own deal where it was our lead sponsorship, our name, and it was going to be our asset.
Got it. So the first kind of investments you went as a limited partner, right?
Yeah, limited partner and co-GP partner, where we were, essentially, like I said, taking a back seat.
Hmm. Yeah, yeah, got it. So what was the first acquisition as a GP? Can you talk about that?
Yeah, the first acquisition was a 261 unit property in Houston, Texas, and that was a, a whole. I could write a whole book on just that, all the lessons learned, all the mistakes made. Uh, so fantastic experience. and we had the many challenges, including raising capital, right? I think people both over and underestimate how difficult it is to raise capital.
Can
When
you
you first start out,
yeah, please, can you talk about that? Yeah, thanks.
yeah. So when you first start, you probably think raising capital is easier than it really is. The reality is raising capital is very challenging. You encounter a lot of no's, and it's not something that you can just set up overnight. It takes a long time to establish relationships, and getting those relationships from the starting point of getting them to know you, then to like you, and then to finally trust you, right? And that's the full
Circle.
series of steps required. And so it's kind of hard to be new and go out there and look to raise $4 million, because you essentially haven't dug your well before you were thirsty, right? It's very hard to dig your well when you're thirsty. And so that is something that I definitely preach, and it's terrific advice. A lot of people are misled by the idea that if they have a good deal in hand, then the money will come.
Mm-hmm.
Or they think, well, first I just need to get a good deal and then I'll figure out the money later. But really, I think it's the opposite. You need to be doing both at the same time, but you need to be absolutely digging your relationship and investor well before you're thirsty, because by the time you need it, it's too late.
Yeah, definitely makes sense. Okay. So any advice for people, who are watching and kind of, building those quality relationships? I mean, how do you start? How do you go about? And like, are you talking about kind of, because of course, maybe there's people who are watching and they kind of have those, accredited type of people in their current network, but how do you expand your reach, and how do you reach more people?
Yeah. So some people, like you said, are lucky enough to have accredited and high net worth investor type of people already in their network. And that's, like I said, that's very lucky, and you can develop those relationships because they already know you. So wait, what you asked is taking kind of the top of the funnel, and how do you bring that? How do you widen that? How do you increase that? And I think, it's pretty straightforward, but it's a lot of work. And so not a lot of people do it. But the best ways are to participate and contribute to thought leadership platforms like LinkedIn, BiggerPockets, Facebook, virtual conferences, live conferences, YouTube, podcasts. So it's a lot of work, and a lot of people, it doesn't fit their personality type to put themselves out there. But that's really the number one way to grow that top of funnel, right? Because now, if you're out on LinkedIn, let's say, or you're on a big billboard, a lot more people are going to know you, but that doesn't guarantee that they'll like you and trust you. But at least that gets the first part going. So that's important. But what I would say is, depending on if you're starting out, depending on what your existing network looks like, it kind of depends where you should be focusing your efforts. Because let's say you're an established professional, that's 45 years old and has a long-standing network, you probably are served best by nurturing your existing relationships before you go out and try to meet new relationships. But if you're brand new and you don't have an existing network, then you pretty much just need to charge ahead and go push on all fronts.
Got it. Got it. Okay, that's a great advice. Thanks for sharing that. So again, your first deal, 200 plus. How big was the deal you mentioned? 200
It was
as a G.
261 units.
261 units. Okay, so the first question first is why Texas? Again, you're based in California, and probably that's where you started to look for these deals, while still being in California. I mean, so what states have you looked at prior to investing in Texas, and why have you made that decision to invest in that state in particular?
Yeah, Texas has many things going for it, such as population growth, job growth, business friendly, tax friendly. And so, but at the same time, those things are no secret. So it's not necessarily that there's a mispricing in the market, right? Those things are priced in. And so you're paying expensive prices in Texas relative to, let's say, lower growth markets. But nonetheless, it's a strong market, and it's a market that investors understand. And so, especially when you're starting out, it's likely a better decision to invest in a market that investors are going to get, right? There are the hot markets that investors love, which is Phoenix, Denver, much of Texas, Florida, Atlanta. These are the markets that are no brainers. Pretty much all investors are interested in, and I recommend that investors don't make it too, or GPs don't make it too hard on themselves and pick too tertiary market or an obscure of a market. So that's kind of what we did. We just kind of followed we followed that idea. And, another reason why we like Texas is it's such a big market that there's a large opportunity set. You don't want to really dive deep, do a lot of market research, build relationships in the market, only to discover that only 500 plus unit multifamily deals trade in that market a year, because it's just not going to be enough of an opportunity set. So Texas is the exact opposite. It's a trading state. People buy and sell frequently, and there's just hundreds of thousands of units.
Got it. Makes sense. So talking about your current investor base, I mean, maybe you can give kind of broad number, like, because it's $100 million of a portfolio we're talking about. So how many investors do you have currently in that as a passive?
So we have over 100 investors, and we have investors that range from, high net worth accredited investors that have, full-time jobs, like, doctors and, people working in tech.
Mm-hmm.
And we also have, family offices and private equity firms that are more of strategic partners or joint venture partners. So they're not participating. They might still be called a limited partner, but they're much more involved,
Mm-hmm.
and they're much more sophisticated, and they are writing checks anywhere from, $2 to $6 million, for example.
Mm-hmm.
So I think it's important to have a diverse set of relationships, because you never know what's going to be the right fit for any given situation.
Mm-hmm. Okay, that's another great advice. Thanks for that. So, talking about the underwriting, of course, and the deals. I mean, you have a book on that, on underwriting. So, can you talk about why is so important to you, and why people should pay attention to underwriting instead of the state itself, which of course we have to pay attention to. But why is underwriting so important in multifamily business?
Yeah, underwriting is really just, it's the core of investing and valuation. All investing is backed, well, all sound investing is backed with underwriting. And whether you're talking about quantitative or qualitative assumptions, you need to still take all those assumptions and boil them down to numbers,
Can I ask you a
so you can
question?
make a decision as to how much to pay.
Can I ask you a question, sorry, before you go into the details? Is it possible, let's
Yeah.
say, for somebody who's involved, kind of try to make any common sense, because of course, if we're going to look at the market, if the property is on sale, that means somebody used to own it and they used to cash flow positive or negative. That's of course when the underwriting comes in place. But that means if somebody is selling the property, if I'm going to buy it without doing the perfect underwriting, is it, and like how is that possible if it's going to cash flow positive, or like is there a percentage, like of course I understand people get lucky with buying a deals when sometimes they don't know what they kind of doing, they don't have no clue, but like is it possible to buy deals without doing the perfect underwriting?
It's definitely possible to buy deals, but like you said, it might get you into trouble later.
Mm-hmm.
And because you made certain assumptions that are eventually proved to be untrue, and now you are potentially at risk of underperforming based on your projections and expectations.
Yeah.
So I mean, certainly it's possible, but I think what you really want to do with underwriting is, at the end of the day, all these numbers and all the calculations are just there to help you make a simple decision to buy or not to buy, and at what price. And so I think the important factor that a lot of people miss is risk. And you kind of have to know what you're doing in terms of looking at the numbers and understanding certain metrics to see what the numbers are telling you in terms of risk, right? Just because a deal says it's a 20% return or a 15% return, it does not necessarily speak to the risk. And so that is something that is really important. And I tried to teach that and emphasize that in my book, because I see a lot of investors just making their decision based on return and not really factoring in risk.
Mm-hmm. And when you wrote a book, have you spoke to the specific audience? I mean, to the people who are looking to buy like 100+ unit deal, or the same book is going to work for the person who's looking for four unit deal?
Yeah, so the book definitely works for, I mean, the target audience are people that are both investing actively and passively into multifamily, likely syndications of 100 units and above. But the same principles apply to a 4-unit. I mean, absolutely. People ask me, "Oh, can I get your underwriting model download?" And I say, "Sure, absolutely." And hey, by the way, does it work for a 4-unit? I say, "Absolutely. it totally works for a 4-unit property. Knock yourself out. And so, although my book is very prescriptive and specific, and I actually walk people through step by step how to use my personal underwriting model, it's not at the same time it's general principles, right? So it's very specific in terms of how to use, but it's also general principles that can apply to more forms of investing than just multifamily.
Got it. Okay. Okay. So, of course, the book that is called The Definitive Guide to Underwriting Multifamily Acquisitions, that book is going to be linked in it down below. So you make sure that you can download that. I'm not sure if it's paid, if it's free, but, we'll give you access to that so you can use it and abuse it and implement in your business strategies. But the question that I have is for your deal criteria. Can you talk about what type of deals are you currently looking for?
Yeah, so we're still looking for deals in Texas, all throughout Texas pretty much. And right now we're in an interesting point in the market. So we typically, our bread and butter, our favorite types of deals are deals that have a little bit of hair on them and work to do. They've been neglected by the previous ownership and they have upside either through renovations, management, or the capital structure. And so those deals typically necessitate financing them with a bridge loan because they're not a stabilized deal, they're a transitional deal. But bridge loans today are more expensive. There's a big delta in the pricing of a bridge loan versus, stabilized debt through Fannie and Freddie. So really, in my opinion, the best buys in the market are deals that are agency financeable, meaning they are stabilized and you can put long-term, conservative, cheap debt on them. So that limits our options today. And furthermore, the returns that we're seeking are very difficult to find in the market. So, to give you an example, we're looking for somewhere around a 16% IRR net to investor. And, that roughly translates in our markets to a 7% return on cost, which, when you're buying at a 5 cap, it's difficult to push the operations up to a 7% return on cost. So those are kind of just some metrics to throw out, but we're very, we analyze very much so bottom up. We look at a deal on a deal by deal basis. Just because a deal's in a market that we like doesn't mean we like the deal, right? We look at the deal bottom up and evaluate all those metrics that I mentioned.
Mm-hmm. Got it. So how many deals do you have come through your table? I mean, how many deals are you currently looking at and having a pipeline? And like, what is the strategy? How many deals are you planning to close on this year?
So our goal is to underwrite at least 10 deals a week for acquisition and then 10 deals a week for preferred equity investment. And so preferred equity, just as a quick aside, is a new strategy that we launched in response to COVID, really, when we saw the structural changes occur in the capital markets. And preferred equity is our strategy where we're actually partnering with other sponsors and we're providing them capital up to 85% of their cost requirements, not equity, but of the cost of the deal. And so it's kind of similar to debt in the way that we're seeking a fixed rate of return and then giving them all the upside, but we're still equity. So we're partnering with them on the equity side, but we're just seeking priority in payment and a fixed rate of return. So it's got a blend of debt and equity in it. And this is a strategy that lets us do more deals, partner with more people, and grow our business. So the preferred equity side has been great. So like I said, we're looking to do 10 deals a week on the acquisition side, 10 deals a week on the preferred equity side. And that definitely keeps us busy. And in a perfect world, that would result in us buying 4 deals a year in terms of acquisitions. And I would say, 15 deals a year on the preferred equity side.
Got it. Okay. So talking about, deal sourcing and, raising capital point, maybe, because I know it kind of works both ways. And what I mean by that is marketing piece. I mean, we kind of live in the digital age, right? Where, you can source deals, you can raise capital, through social media. And I came across multiple syndicators, multifamily investors who do that successfully. So what type of strategies are you using for your marketing? And, does it help your business scale the business, raise capital, source deals through marketing techniques? And maybe you can share a few.
Yeah, I think the power of putting yourself out there is absolutely tremendous for the business that we're in. The more people that know us and they can work with us either by being an investor. They can work with us by bringing us a deal and they want to partner on the preferred equity side. So there's lots of ways that we can work together, and that's exciting for me because it just makes all these relationships that I'm making very valuable, and so that's motivating. And so I think for us, our strategy is produce high quality content that people are really going to enjoy and talk about, and that's what's going to get not only people to know us but also to like us. And then obviously the trust component that I mentioned before doesn't happen overnight. That happens over time through more exposure, phone calls, kind of showing track record, showing previous experience, and kind of keeping up with what's happening. So I recommend people to, if you don't have a newsletter, consider starting a newsletter, but at the minimum, just keep the people in your circle updated on what's going on. So if you have a win, no matter how small, share that with them, and that just kind of builds that confidence and that trust. So that's our strategy. We have, I write books, I write articles, we send out newsletters, I make videos, podcasts. Really just trying to put ourselves out there.
Got it. So of course, like the blog articles you can find on LoneStarCapitalGroup.com. It's all about underwriting, deal structures, capital markets, and more. But the Capital Spotlight podcast, can you talk about like what type of format are you using for the podcast? Do you have guests on just like we're talking right now? What approach are you taking on a podcast?
Yeah, so the Capital Spotlight podcast is a way for me to connect with capital providers in the space and really sit down for 30 minutes to an hour and pick their brain as to what they're looking for in terms of an investment partner, what they're looking for in terms of a deal, and how they structure those deals, and just anything like that. So it's a great opportunity because a lot of sponsors like myself are we want to build relationships and get into the minds of more institutional type of investors, whether we're talking about $200 million funds or larger, or we're talking about family offices. I think those are really valuable investors. And for some sponsors or syndicators, they're not looking to build those relationships, and they want to continue to build their retail network of high net worth individuals. But there's quite a few sponsors that have aspirations to break into that more institutional space and get partners that are capable of writing 5, 10, 15, $20 million equity checks. And so that's what I'm also very passionate about. And so the Capital Spotlight podcast is where I bring those types of guests onto the show and ask all the questions that so many of us want to know. For example, what markets are you investing in? What experience requirements do you have for your sponsor partners? What are your return hurdles? What kind of fees do you let the sponsors charge you? We all want to know these types of things.
Got it. So how often does the episodes come out on the podcast?
So I was pretty ambitious when I first started it, and I was hoping to be able to put a new episode out every Monday. And I quickly ran out of guests because I need to grow my network. So that's my fault.
Makes sense.
But so I'm working hard to continue to bring very high quality guests onto the show. And I don't mean quality as in just, these are the best people in the world and everybody who's not on the podcast is not high quality. All I mean is specific to the niche and specific to the topic, which are, preferably institutional capital allocators, right? So I'm not looking for sponsors. I'm not looking for, just everyday investors. I'm looking for professionals in the capital allocation business, specifically to commercial real estate, even better if it's for multifamily.
Here we go. So anybody who's watching fits that criteria, make sure to get in contact with Rob for the podcast episode. Here you go. So look, 23 years old, I have to come back to that, 23 years old and having, $100 million of multifamily deals. Again, I don't think that everybody who's watching, they want to get involved into the business. Maybe they're about same age, younger, a little bit older. Maybe they're not lucky as you've been, which I think you've been lucky having family, your father who's been a good mentor of yours, kind of giving the advice and guiding you when it comes to starting your own personal business. like what tips would you recommend or give, for the people, who's watching, like the stepping stones, how to go get involved with the multifamily business?
Yeah. So first is education. And that sounds simple and straightforward because pretty much anything that you starts with education. But I think what I'll say is it's not it's not a 2-year process or a 5-year process to become educated. You can really, if you just really want it and you are really passionate about it, within 6 months of making it your life and going to every meetup, every conference, taking every phone call in, and being brave enough to reach out to people who you think may not be accessible, reach out, have conversations, put yourself out there, be willing to say that you don't know something so that you have the chance to learn. Because when you just sit there and say, okay, then you don't learn whatever that you didn't really understand. So it's putting yourself out there, I think, is really important to get that baseline of education. And then from there, it's having the confidence to continue to put yourself out there, um, to now build those relationships further, and not just coming from a position of I want to take and learn, but I want to communicate and contribute and grow together. And that's where you start to see opportunities come to you. So when you are talking to people, deals will come your way, investors will come your way, when you take this approach of, wanting to contribute, give, and grow.
Got it, got it. And by the way, I think we just lost 50% of the audience when you said go to these events, do this, do that, connect with people. Like, man, it sounds like a hard work to do, which is probably is. But look, that I think that's what it takes. I mean, I don't think I know, because you're going through the same and building the business, so you're kind of giving the tips of what you're actually doing and did prior to that. So, but I think it could be a little bit too early to ask you that question, but I always ask that question because I want to kind of dig in deeper into the core and find out what the true reasons for the business person are when it comes to building the business. Because you're still 23, but let's look. I'm still going to ask you the question: like, what is the legacy that you're looking to leave behind you?
Well, the thing that really drives me is any pursuit of excellence. And the point of it is not to achieve anything or to get anywhere. It's the journey, and that's obviously cliche, but it's very true. And a fool, I always say, and I can't remember who said this, but a fool is someone who achieves his goals, because you should be constantly raising the bar higher and higher, because it's no fun to just get to the top of the mountain and then just say, okay, I'm done. So I'm not looking to leave any specific legacy. I don't want to, uh, you know, build something and then be able to say, here's my thing that I built. I just want to, you know, be known or not known, but just to consistently uh, pursue excellence in whatever I'm chasing.
Here we go. That's a good enough answer. I mean, it works for me, and it does make sense. I love the fact that you're using the quote that it says, keep reaching for the new heights and new levels, because there's always a new level. Even when you find there is no room, there's always more room to improve and grow. So, I mean, I love it. Again, the information that you provide, of course, we can go, in depth, and we can go as long as we can talk here probably another, couple hours and kind of discuss the underwriting process. But hey, look, there's a book for that people can go and download. So we're going to make sure that we put that there so people can grab it. But I really want to appreciate, say a big thank you for being today on the show. I mean, just coming back to the fact, I don't know why my brain just coming back to, like, you're 23, $100 million in real estate, which just doesn't happen that often, for people your age. So, congratulations on that, definitely. Guys and girls, make sure you connect with Rob. Of course, as I said, if you fit the podcast criteria, that will be awesome. If not, just contact him, and talk real estate, passive active investing. I'm sure he will dedicate a few minutes for you so we can talk real estate, because this man is real go-giver, and he's passionate about what he's working on. So Rob, thank you for being on the show today. I appreciate it.
Yeah, thank you so much for having me.
No worries. So guys and girls, before we go, just one thing that I wanted to ask you: if you share this episode with a friend of yours, that one who always talks about real estate and investing but never pulls the trigger, make sure to send this episode his or her way, because that person is going to find a lot of inspiration, strategies, tools, techniques, how to start their own personal multifamily business or get involved with it passively. So make sure to do that. Rob, again, thank you for being on the show. And as always, I will see you in the next episode. Thanks for watching.